Welcome to ODEON Capital Conversations on all things money and markets with Dick Bove and Matt Van ALSTYNE. And here is your host, John AIDAN BYRNE.
On this episode, Dick Bove explains what drove the US federal deficit to $1.7 trillion in the latest fiscal year and some of the biggest outlays. US federal debt continues to mount. An accounting change meant the latest deficit escaped reaching a more massive $2 trillion. We look at all the numbers. Matt Van ALSTYNE raises questions on the plunge in individual income tax collections as reported in the deficit numbers by the US Treasury Department. We look at the sharp increase in defaults on US auto loans as well as on US credit card loans. Bond King Bill Gross sees a recession by year end. We'll discuss. We look at China's challenged economy and its troubled Belt and Road Initiative. And we look at the lessons of history from the Great Depression until today and why we should be hopeful. I'm with Dick Bove, Chief Financial Strategist at ODEON Capital Group, and Matt Van ALSTYNE, ODEON Co-founder and Managing Partner. And we'll be right back after this message.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.
Dick and Matt, episode 92. We'll talk about the economy, auto loan delinquencies, the banking system, and lots more. Global affairs, the situation in Israel. But first, the US government on Friday said its deficit rose to 1.7 trillion or 6.3% of gross domestic product in the year ended September 30th from 1.4 trillion or 4.4% of GDP a year ago. And by one account, it would have been much larger, 2 trillion, but there was some kind of an accounting change related to student loan cancellation. So that'll probably be factored in, I presume, later on. And the US government is spending $659 billion this year paying off the interest on its debt. This is an absolute nightmare. Are we at the cliff edge? Dick, you've been looking at a lot of the numbers and breaking it out.
The Treasury Department did come out with its bulletin also this week, and it shows that actually the expenditures by the United States government went down by about 200 million in the 200 billion in the period. And the reason was what you said. The Education Department had a decline of $680 billion. It's hard to get these numbers right. And it was as exactly what you said. It was something to do with accounting for, the student loans. And there were two entries in the budget related to this accounting, which is what added up to that 680 billion. But without that, the deficit would have been substantially higher in the period. So it looks like an accounting gimmick allowed the deficit to come down. But right now, this whole thing of a budget deficit has become a major issue. There's a conference going on in Saudi Arabia right now, and in that conference, one of the issues that was brought up by my buddy Jamie Dimon. Never in the history of the United States have we had a deficit of this nature in peacetime. In other words, in wartime, you have outlandish deficits, to pay for the war. But at the present time, we are not at war. And the reason for the increase in the deficit, well, the military budget did go up in year over year. But the primary reason for the increase was the increase in interest on the debt. If you take a look at each one of the segments of the budget, and there are 32 budget lines that you look at to come up with this information, the increase in the debt and interest on the debt was $162 billion this year. And we're not stopping in terms of that going higher. That was the biggest source. Of course, Social Security was the other biggest source. Then the Department of Health and Human Services, which is where we spend most of our money, was next. And finally, defense was up $49 billion, which is far less than people thought it would be. But it was number 4, number 5 in terms of the increase. But it is clear that on the outlay side, we've got a problem. Because, as I say, there are 30 budget lines that are published. There are actually 600 lines, but 30 comprehensive budget lines which are published. And of the 30 comprehensive budget lines that are published, I believe only 6 show declines. So every element of the U.S. government is increasing the amount of money it spends to do whatever it does. And that could be everything from civil defense programs to the House of Representatives to the Department of the Interior. Everyone is increasing, and they're not increasing by a small amount. They're increasing, on average by 13%. And that's obviously some below, some above that. Clearly, no one's interested in controlling spending, for the United States government. They're not doing it. Then to make the situation a little bit worse, on the other side, the income that we receive from, taxes went down by $455 billion. And the reason for that decline appears to be twofold. Number one, most important, reduction in capital gains taxes, because the stock market has not gone up anywhere near the way it did in the last couple of years. And number two, the money supply is shrinking. And as a result to that, there's fewer dollars in the banks. That means fewer interest payments to depositors, which means fewer tax collections on interest. But the primary reason was the decrease in the capital gains tax. But the bottom line is, it is definitely very troublesome because we're not increasing the revenue of the United States government. On one hand, we are increasing the cost of running the United States government, right across the board. Right across the board. And there's no one out there attempting to stop it. Now, whether these Republican congressmen who got Mr. McCarthy dumped from his position were wrong in what they did or not, their basic argument is not wrong. Something has got to be done about this because it is out of control and it cannot continue.
On your chart, which is just fascinating the way you laid it out. And, John, you're almost convincing me we need to do this video so we can show these things. But
we will eventually.
But the big one was in fiscal 2022, the government received $2.6 trillion in individual income taxes. And in fiscal 2023, it was 2.17, a difference of 17.3% decline.
Right.
If you told me individual income taxes declined 17%, I would assume we're in a depression. How is that possible that income taxes can drop that much and yet GDP nominally is still being reported as growing relatively healthily? Yeah,
well, it is confusing most people, myself included, because there are more jobs. We have more people employed, I understand, today than ever before, and the disposable personal income is going up at the same rate as expenditures. So everything would argue that it was the capital gains situation because, ordinary income taxes should be going up. There is no new tax cut law in place, and one goes out of position, as you know, relatively soon. The point is that it is difficult to fathom. I've been, trying to find someone who has a clear understanding of why this $455 billion drop in income taxes occurred. And the only explanations I can get are the two that I suggested. Number one, capital gains taxes are down dramatically this year because the stock market has not gone up. And number two, the money supply in the banking system has gone down also dramatically this year, which means less interest income from that source. However, interest income from other sources clearly went up. It's difficult to understand. It's very difficult to understand.
The other one that stood out to me was the unemployment insurance. They received $66 billion they being the US government in 2022, but only 49 billion in 2023. And my understanding is unemployment insurance is almost a direct line to W-2 salaries. So does that mean salaries overall, the entire country dropped by 25%? Again, I would think if you told me that, I would think we're in a Great Depression. Like, these are just phenomenal big drops year on year.
Yeah, they are. The unemployment number, what I come up with there is, if you take a look at the characteristics of the people who are being employed at the present time, it's highly likely that a lot of them never pay taxes. In other words, we pointed out, I think last week, that 70% of the new hires came from three places. One was, we'll say recreational, tourist type jobs, which, could be bellhops. Second was health, which could be a lot of people in low income positions that move ambulances or what have you. And then third being the government, and those people make a lot of money. The point is, if the increase, and by the way, only 10% of the increased jobs came from, production workers. So if all of the jobs coming into the system are essentially paying such low income that, a high percentage of the population doesn't pay income taxes at all. They make Social Security payments because that's mandatory. They can't not make that payment. They have to make Medicare payments because they can't avoid that payment. A lot of people just don't pay taxes because they don't make enough money to do so.
Yeah, it's crazy that income tax receipts can drop 17%, unemployment insurance receipts can drop 26%, yet we're in a booming economy. It's just crazy. It just doesn't add up, just on the first glance.
The thing that makes it even more confusing to agree with what you're saying is that the Atlanta Federal Reserve is indicating that the third quarter GDP is up something like 5.2%, which is the highest increase it's been in I don't know what amount of time. But the fact of the matter is, the economy, you're right, Matt, the economy is growing, and it's not growing at a normal, slower pace. It's growing at an active pace, and yet the income to the United States government, not only did the income taxes from individuals go down, but by a very small amount, only $5 billion, the corporation income taxes went down. To make it more confusing, the Social Security payments went up 127 billion or 128 billion. So people are paying more in Social Security because they have more jobs, but they're paying less in income taxes. And again, I think for two reasons. They're not paying any taxes, a lot of these new people with jobs, and, wealthy people are not getting hit with this bigger capital gains tax. But it's a tremendous anomaly.
So, Dick, the federal government, if I got this correct, is spending more than it collects in tax revenue.
Yes, it's spending more by, roughly 200 billion. The number I got is 276 billion. The federal government outlaid this year $6.1 trillion, and the federal government took in, according to this, $4.4 trillion, which of course leads to the big deficit. Again, the deficit is much bigger than the numbers I just showed you said, because as we started off, and you said this, John, but as we started off, the Department of Education shows no expenditures for it during fiscal 2023 because of this huge, $680 billion reduction in its costs, all of which were associated with a change in the accounting for student loans.
Yeah. It's gut-wrenching. It's extraordinary. So the federal debt is now at 33.2 trillion. All of that excludes unfunded liabilities and municipal debt. We're not talking about that. So once we can keep funding this and having willing lenders, I guess we can continue to some point. But is there an actual tipping point? Can it go to 40? Can it go to 50? Or is that a pipe dream?
Well, I thought the tipping point was 25 years ago. It's an actual tipping point. But, it just seems that the demand for the United States dollar is so strong. And the United States dollar is so dominant at the moment in terms of transactions around the world that people are willing to continue to take the dollar despite the fact that there is no backing to the dollar. If you take a look at the books of the Federal Reserve or you take a look at the books of the U.S. Treasury, I don't know when it ends. As I say, I keep thinking every year it's going to end. And certainly if we have a recession, and this budget deficit, jumps back up to 4 trillion, which is where it was in 2020, then I would assume we're in big trouble.
And then we have dysfunction in Congress. You did refer to it earlier. You understood the angst of those holdouts in the speaker vote. They do have a case in point, but not having a speaker is another matter.
These people have got to get it together. They've got to get control of this budget. They have got to stop, every department in the 24 of the 30 line items here, it will say 24 of the 30 departments of government cannot increase its spending every year. And they didn't increase spending by a small amount. I didn't come up with an average number in terms of the increase in spending, but, it ranges, in my view, just eyeballing the data, somewhere around 10 to 12%. These units of government are increasing, agricultural science research is up 10%. The legislative branch, which is, the amount of money spent by Senate and the House of Representatives, is up 13%. Research activities by the Department of Agriculture is up by 13%. We can't afford this. Federal crop insurance was up 52%. The United States cannot afford to continue to do this. So, at some point, hopefully, a crisis of such magnitude will develop, maybe at the end of November when the government shuts down, that will get some rational people running, the legislature, and they will finally create a budget. I think Matt knows.
I'm sorry, Dick. I left my smelling salts at home.
No, but you said
the optimism from.
When was the last time the United States, operate off a budget? I don't remember.
I think it was in the early 2000s. I think it was under George Bush in his first term.
Yeah, so it's almost 20 years, we'll say, before, the United States has had a budget submitted to the House of Representatives. The House of Representatives have agreed to that budget. The Senate has agreed to that budget. The president signed off on it. If it's 2 decades ago, you can understand why this thing is just the Wild West. It's the Wild West. It's just crazy. There is just no controls anywhere in this government. And I don't know. Know when the tipping point occurs, to get to your point, John, but it's got to be soon. It can't be late.
Well, we're going to pile on the misery a little bit here, Dick, with some numbers you have on the soaring default rates on auto loans and what that means. Inflation-pinched consumers are now defaulting on their auto loans at levels not seen in almost 3 decades, with high borrowing rates putting on the squeeze. Some interesting stats, and you have a lot of data on this, Dick. The number of subprime auto borrowers at least 60 days past due rose to 6.11% in September, up from a previous high of 5.93% in January, according to Bloomberg and Fitch. And those with the best credit scores of at least 750 average rates they're paying on their auto loans is between 5.07% for a new auto and 7.09% for a used. But if you've got lower credit rating, you can be paying as high as 14.8% to 21.38% on your auto loan. So some cracks there in the auto loan sector, Dick.
Yeah, well, we did mention, a few months back that people were seeing that their amount owed on their auto loan was higher than the value of their automobile. And since I mentioned that, in the one instance, I don't know how many months ago, people have contacted me, just in casual conversation. And basically, there's so many people out there in that position that it's mind blowing. Not only is the value of the car somewhat less than the amount outstanding on the auto loan, but since we've gone to auto loans which go out, 4 to 7 years, you're stuck with making payments on this car, which isn't worth the value of the loan, for maybe another 3 or 4 years. And a very high proportion of people are simply saying, this makes no sense. Take your car back. We're not going to pay it. I always, again, there's the boyfriend of one of my granddaughters is a debt collector. Okay.
Jeez. I like that. Yeah.
And so as a result of chatting with him, and how his company works, apparently there are hundreds of people now, who are operating off of data which comes into them from the places where the defaults are occurring. And he says he makes 50 calls a day, and he works 5 days a week. So he's making 250 calls a week, to collect. And, basically I don't know if his collection rate is any good relative to others, but maybe he'll get, 6 or 8 collections out of that, 250 calls. And there are hundreds of people that work for his company that are doing the same thing. Not effectively, there are thousands of people making tens of thousands of calls, to people who have fallen behind on their debt. And they're getting just an incredibly low hit rate in terms of the people who are willing to pay. I don't know, it's the bifurcation of the households in the United States to this massive amount of people out there who simply cannot pay their bills, that haven't yet shown up in the statistics, and this large amount of people who are in good financial condition, who have no difficulty with the current economy and the prices that they're paying in that economy. But this failure to pay, is a problem from the lowest element of households in the U.S. economy up to the U.S. government itself, where you've got the situation where the debt is rising at a rate much faster than their ability to pay for it. And the only result when that happens is, huge numbers of defaults, failures of financial institutions, and a real problem in the U.S. economy.
I think Matt last week mentioned that the number or percentage of U.S. households living paycheck to paycheck is at a huge all-time high. 50-60%. It's a huge number. So, and then inflation is pinching pockets. An interesting side note on auto loans and sales, because my son just bought an auto recently and I went to the car lot with him. It's much easier now to get autos, obviously, if you think about it, with lower mileage than maybe a decade ago, because there are more people working from home. I just thought it was an interesting phenomena, but it doesn't take away from the fact that we're having huge delinquencies.
Yeah, no, car sales are weakening also. I mean, car sales are no longer growing at the rate that they did a couple of years ago. Car prices, because of this auto strike, are starting to move up a little bit. I mean, they indicating that this morning when they were talking to CFO of General Motors. But basically, car sales are not strong. Car prices are still rising. These loans are still being made, although a number of big banks have simply walked away from making loans on automobiles. Fifth Third is a huge bank in the United States. Regions Financial is a big bank in the United States. They have pulled back their willingness to make loans in this area.
What is the reason for that, you think, Dick?
Well, I think that they're losing too much money in the business. Is
it because of defaults and the collateral is no good, or is it just because of defaults and it's just not worth it?
To be honest with you, I actually think it's because of the way they underwrite the loans. In other words, when a bank makes a loan on a car, first they have to sign up the dealer, right? And they got to cut an agreement with the dealer. The agreement essentially is that, you cannot charge more than 150% of the blue book value for that car. A lot of banks have not made that requirement. Secondly, you cannot charge above X percent, 150 basis points above the rate that we give you or what have you. A lot of banks didn't make that requirement. But the third requirement that they didn't make, which was the most important, is you don't pay the dealer the amount of the loan for 6 months. You wait for the owner of the car to make payments on that car for 6 months, and then you pay the dealer the amount of the loan, because the dealers can jam so many of these loans through the banking system and no payments are ever made on them. So I think it's banks who don't understand how to underwrite a loan on a car. I think it's faulty underwriting that resulted in a lot of these banks saying, what the hell am I doing in this business? I'm getting out. I just can't take it anymore.
Do you think the rise in, you mentioned the rise in car prices. Do you think that's structural? Do you think it's like a lack of supply? Do you think it's just generic inflation? Or, as a lot of people think, like the Wall Street Journal thinks it's because of regulations that require the car companies to spend so much money on inefficient cars, they have to subsidize it by raising car prices?
Well, I think all of the above. And I think that last one is probably most important for the U.S. economy, way beyond cars, right? We have regulation in the United States for the workplace to make the workplace safer for employees, to work so that they don't get injured or they don't get harmed or what have you. We have all sorts of, requirements related to pollution. We have requirements related to, the amount of hours worked, who can work it, what the minimum wage rate has got to be. We have so many rules.
You'd prefer to go back to just a more free market, and that would lower prices. That's probably my view.
So. Yeah, no, I agree. I'm saying it in a more long-winded way.
The problem is when you phrase it like that, you're saying, oh, we have all these rules to protect workers. Well, I don't want workers being killed or getting harmed doing, I think we should have rules that protect workers. I would argue that my guess or hunch or maybe bias is that a lot of the rules are to create extra jobs, like the idea that we can't change a light bulb in our offices in New York City unless we have a union worker and a colleague come to well, we're not allowed to do it. They have to come do it together, but we have to have two people come, one to change the light bulb and one to observe the safety standards are adhered to. It just seems like a jobs program in some ways. And so I don't think it's anti-person to say I want rules that protect workers, but what you're saying, I think, is that the rules aren't efficient and they go beyond the stated goal of putting the rule in place in the first place.
Yeah, well, they're excessive. They're excessive because they touch upon everything. Let's assume you want to build a plant near a marsh. You got to make sure you don't kill any of the animals in the marsh, right? There are rules that have been set up by communities, by states, by, counties, by the U.S. government, by the agencies of the U.S. government, all to protect something, and these to protect something rules have driven the cost of production in the United States up to a level which makes us non-competitive with Southeast Asia, where they have virtually no rules.
I want to swing back on that, going back to the budget stuff that earlier on, the third biggest decline on the categories was customs duties. It went from 100 billion down to 80 billion. And do you know if that's due to change in policy under Biden versus Trump, or like they lowered tariffs or whatever, or is that due to like less imports? And is the less imports due to, if it's less imports, is it due to a slowing economy? Again, like I talked about with the income taxes and stuff, like you look at a 20% decline in customs duty, you would think, oh, we're in a recession. Or is it because what you've been preaching for a long time is that manufacturing has been resurgent in America and there's just less imports because we're able to produce more ourselves? What do you think the reason is?
Well, I think it's a downsizing of the product that's being imported, but that I can't prove that. In other words, I think if you're going to import earphones instead of machines, the duty is far less. I don't know if the Biden administration has reduced the tariffs that were put in place by the Trump administration. They can claim that they have not, but I don't know that that's the case. And I don't know if they've reduced the fees, in that area. So I don't know the answer to the question. I do know you're right about the number because it's pretty clear.
Americans are also defaulting on credit card loans, with delinquencies hitting 3.6% so far this year. That's a 10-year high. But the credit card industry is exceedingly profitable, Dick, at the same time. With the rates they're charging, and we're not beating up the credit card industry, that's their model, but Americans are defaulting on credit card loans at a record pace right now.
Well, yeah, basically the credit card industry, takes care of that with the interest rate that they charge on the credit card. The reason why you're paying 22% on a credit card loan, and we'll say 8.5% on a car loan and 7.5% on a home loan, is because there's no collateral behind the credit card loan, number one. Number two, the credit card loan is made to just about anyone with virtually no underwriting done other than taking a look at a few statistics like the FICO score and things of that nature. So the credit card industry does normally have much higher default rates than any other sector of the lending arena, but it doesn't affect their profits meaningfully because of the fact that they charge such a high interest rate in the expectation that will happen.
Yeah, but it's also pushing consumers deeper and deeper into debt. I guess that's a personal decision that they make. Is that how we look at it?
It really does come down ultimately to the household, right? Yeah. The household shouldn't spend, too much more than they make. I mean, they got to borrow money to buy a house. Presumably, they have to borrow money to buy a car, but there's, they've got a budget, and they don't budget, which we'll see the result of. I think we're seeing it absolutely right now. We don't budget. The government doesn't budget. The world economy doesn't budget. We have money being created and sent out and covering all of this stuff. And as I said, I thought 25 years ago we couldn't continue to do that. But we did it and did it some more.
We have a few new listeners. Marius Mihe, he's an assistant professor of economics and finance at John Carroll University, and Adma Kadiyala, founder of Bayou Financials, and she also is a professor at Pace University. I mentioned that because I was at a trading and market structure conference at Baruch last Friday, hosted by Professor Robert Schwartz and his colleagues at the Sickland School of Business. I bring it up because Marius mentioned he looks at the banking industry and he was fascinated by some of your data, and he cited Capital One when we were talking because of the consumer orientation of Capital One.
Well, basically, we have had a sell recommendation on that stock for a while, and we have no connection with Capital One. We have a lot of written material on this, and if you contact ODEON Capital, you can get all of the provisos associated with that recommendation. But the point is that the reason we have a sell recommendation on it is that Capital One is one of the largest credit card companies in the United States. And surprisingly, to most people, they're also one of the largest auto lenders in the United States. They're fourfold, so to speak, in the industries that have the biggest amount of risk, which is the reason that we have a sell rating on the stock. Because even though I have a tremendous respect for Richard Fairbanks, the man who runs it. I think he's a genius, and I think what he's done creating this company has been phenomenal. And this company is one of the absolute best in terms of handling its clients. It can't avoid, it just can't avoid getting hit if people spend too much money and can't pay the bill once they've spent the money.
Another interesting metric here, Dick, on the same tone. The average monthly US mortgage payment is a staggering 52% higher than the average monthly rent on a house or apartment in America, a ratio that hasn't been this sharp since the 2008 housing crash. So while the costs of rentals is certainly in the metro areas like New York and New Jersey, maybe Chicago, I presume too, and other areas, and maybe your metro area, while rents are going up, it's still cheaper to rent than buy. It's become prohibitive because of rising mortgage rates.
And we have to take that statistic and say you're saying 52% of the purchases of new homes today because I don't pay any rent on my home, right? And most people, and I think 30% of the people in the United States don't make any payments on mortgages because they paid them off. So the net effect is the vast majority of people who live in homes, do not have this problem because, and Matt has pointed this out.
Yeah, exactly.
If you got a home and you got a 3% mortgage, you're not paying anywhere near what the rent is, to rent. The amount is to rent. But it's housing prices are up because there is a legitimate supply problem in the housing industry. It keeps them up, but they're not going to stay up if mortgage rates continue to rise because people's incomes are simply not growing as fast as the monthly payment on a mortgage.
Yeah, you're right. Matt has pointed out repeatedly that most people are sitting on low mortgage rates or own their homes, so it's a smaller percentage. The stat is somewhat misleading, but it is accurate at the same time.
It's definitely accurate. I think the real problem, if I were a policymaker, and I wish we had leadership, and I wish we had policymakers instead of our Congress, which can't even elect a Speaker of the House. I mean, it's a joke up there, is that the real problem with 65% of Americans having homes and the other 35% being renters is that there's a huge wealth gap. And, you look back through history, when the wealth gap gets too out of sync, that's when problems arise in a society. And, as much as I dismiss and poo-poo the idea that, the economic fear porn that you see where it's like, oh, mortgages, it's never been a worse time to be a homeowner. And you're like, well, unless you already own a home, it's just never been a worse time to start owning a home, is that it creates and perpetuates the wealth gap. And the wealth gap is something that I think everyone should be worried about. And I wish our policymakers had more of a view as to stabilize it, because it's really hard to climb up the ladder of economic health and economic wealth when you can't even get to the first rung, which is often seen as, buying a home for the first time.
Dick, you've taken a fresh look at China, and your own words, it has meaningful problems with its loans to third world nations. According to Greg Ip in the Wall Street Journal, don't rule out a China financial crisis. We'll get your thoughts on China. And he says, this is Greg Ip, who's a great writer on these matters. China has a deflating property bubble. Its governments are struggling to pay their debts, and the banking system is heavily exposed to both. He said the conventional wisdom says that debt owed to domestic investors shouldn't be an overly worrisome sign, but he says the conventional wisdom could be dead wrong in underestimating what this debt could unleash. China continues to have problems.
What amazes me is that it doesn't matter how much money you have, you're going to go out and borrow a hell of a lot more, because there's no reason for China to have a financial problem, given the fact that their trade surplus is so enormous with the rest of the world, and they keep getting foreign currencies, coming in on a regular basis. They have staggering amounts of dollars that come in, as a result of Americans purchasing Chinese goods. It's always shocking to hear that China is in the financial condition it is, but clearly it is. I mean, we know that in the real estate sector, because we've talked about this before, that they've got terrible problems because they've got some 80,000 apartments or condominiums they've built that are empty, and they haven't even finished building them. We know that some of the companies are now defaulting on loans that no one ever thought a Chinese company would do. But the point that I was trying to make this week in the notes that I sent to you is that this Belt and Road Initiative, which they created, is in deep trouble. In other words, the Belt and Road Initiative is a system that the Chinese thought of to link countries to China, get these countries to buy more Chinese products. And, if you take the dark road the way I think Matt does, it was a way to get China control of the natural resources of a number of these countries. So the net effect is they lent money to 150 countries. I didn't even know there was 150 countries. And depending upon whether you believe the Harvard numbers or the Kiel Institute numbers, the amount of money loaned is anywhere between 1 trillion and 6 trillion, because you don't get the specific data concerning what the conditions of these loans are, unlike if the IMF or the World Bank had made the loan. The net result is you've got companies from Argentina to Pakistan to Tanzania to Kenya, that can't repay the loans. and they don't want to give China, the rights to their natural resources, and they don't want to give China, the rights to, the highways or whatever it is that China built. So we now have a situation which, to me, is favorable to the United States in that these countries are looking at China as a colonialist overseer because they owe so much money to China. The thing that's annoying about what the situation is they're running to the IMF and the World Bank, which are supported primarily by tax dollars from people in the United States, Japan, China, and other places, and asking the IMF to make the payments on the debts that they have. I mean, Argentina in particular is begging the world, the agencies that I mentioned, to come up with money to help them pay down what they owe China. And these agencies are coming up with money to pay down the debt to China. I guess the theme of this podcast is, debt is out of control everywhere, in the world. It didn't matter what the country is. It doesn't matter what the, household is. It doesn't matter if it's the United States. Debt is out of control. At some point, and again, I don't know where that point is because you've asked me that, John, earlier. At some point, all this debt is not going to be repaid. And when it's not repaid, it's going to be a terrible event for the world economy.
Two points. First off, one man's debt is another man's asset. Let's be clear. Yeah. When I personally shifted from stocks to owning bonds because they pay 5%, it becomes my asset. I have a bond that pays me 5%. I like that asset. So the idea that there's going to be a massive default one day, or what other people talk about as a debt jubilee, that someday they're just going to wipe it all off and let's start over, is kind of unrealistic. And when you talk about how it's not going to be paid back, I think I agree with you in nominal terms, because there's multiple ways you can not pay back debt, and one of it is through inflating it. And you can do it on purpose, you can do it on accident, but it's possible that the end result of this is a period of hyperinflation that is global, and it resets the value of assets and debt throughout the world.
Historically valid, right? In other words, it's historically valid to indicate when, going back to Rome, when a country or an empire, in that case, gets so indebted, ultimately, they continue to inflate the currency. And as they inflate the currency, they are able to extend out the amount of time to repay the debt. But ultimately, even Rome had to pay it. All right, they lost their empire. But the point is that you're right. Historically, that's the way countries try to hit this problem. They try to use inflation to get low cost money, low value money to pay back high value money, which is what they borrowed in the first place.
The bond king, Bill Gross, sees a recession by year end and says he's going deep in the weeds, he's buying futures tied to the overnight financing rate. He said he expects the gap between 2 and 10-year yields, as well as the difference between 2 and 5-year yields, to go positive before year end. He went on to say in an interview, this is your area, Dick, regional bank turbulence and the rise in auto loan delinquencies, which we had been talking about, suggest a significant slowdown in the US economy.
Well, yeah, I mean, he and Bill Ackman, what was the movie, The Wonderful Vacation or what have you, but these two guys have come out with terribly negative views of where the economy is going. And today, David Solomon at this conference in Saudi Arabia, Jamie Dimon, all these, so to speak, learned people who are well entrenched in the financial industry are suggesting that, we've reached the point that this can't continue, and that it's a scary and frightening time, and that the result or the end result is not going to be positive. So, I mean, all I can say is we'll see. Obviously, I'm in the camp of believing that the economy is going to slow down dramatically also, but, it hasn't happened yet.
And then putting all of this together, looking at the big global geopolitical map, we have a conflict in the Middle East, a war in Israel, Ukraine, Russia. Our domestic economy and political situation is a total disaster. I mean, the American people are divided, and we've the border. Can all of this be cleansed out? Can we come out of this eventually? I know there needs to be a strategy, and hope is not a whatever you said last week. Hope is not a strategy, obviously, but
I'd love to hear Dick's thoughts, because when I sit and watch the news or read the news or whatever, I get really sad and depressed. And then I talk to my parents, and they talk about how, in the 1960s, you had presidential assassinations. You had Martin Luther King assassinated. You had riots at a Democratic convention in Chicago. You had a war in Southeast Asia. You had the Cuban Missile Crisis. Like, the 60s sound like a terrible time. And then we graduated from the 60s to the 70s, where you had a president who was going to be impeached, who had to resign in disgrace. You had hyperinflation. You had a war in the Middle East. You had the just continual trend of just negative news for 2 decades, and we bounced out of it. Like, I kind of sit and think, right now is not as bad as back then. I mean, we don't have the assassinations. We don't have the ongoing actual riots in the streets at political conventions yet. What do you think, Dick? I just wonder if this, like, I'm sorry to put it on you, but I wasn't around back then. I think maybe you were. Like, is there a parallel?
Well, I mean, I think I'd go back even further, because I was born in the last couple of years of the Depression. So
you look fresh.
But the point is that was followed by World War II, and that was followed by the Korean War, and then we went to this period of magnificent prosperity in the 50s and up to the middle of the 60s. The beginning of the 60s weren't crazy, up to the middle of the 60s, and we always come out of it. Unfortunately, we go through periods of high stress before we come out of it, and I think we will go through a period of high stress because we have to get rid of some of this debt. But we will come out of it. We always come out of it, and there's no reason to assume that we won't come out of it this time either. It's just that, we've got to cleanse a few things. We've got to get a real government in the United States, which apparently we do not have, and we've got to take the actions that a real government would take to solidify, our budget, to get real production coming out of the economy. All those things are going to happen. The problem is, how much stress do we need to go through before they happen? But we will come out of it, absolutely.
Interesting. A lot of the folks I've met who grew up during the American Great Depression tended to have a much different, understandably, mindset from younger generations, more prudent and probably more conservative and careful with their money. So these mind shifts occur generationally, and it impacts the economy one ways or the other.
Yeah, no, it does. But I think I'd like to leave with the thought that, the United States has often been in periods of extreme stress, but in those periods, we seem to get things together, and we definitely come out of it. We definitely come out of them.
That's a good note to end up on. And inflation is down from its high. Unemployment at 3.8%. People are spending, and we have the AI revolution. And so there are some positive things we could talk about later. But we're at the end of our conversation. Dick and Matt will come back next week for more of Odeon Capital Conversations. That will be episode 93. And until then, take care.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only, and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.